On July 10, SK Hynix lists on the Nasdaq with 60% of the AI memory market at the $1 trillion valuation. Micron has 20% of the same market and is currently valued at $1.2 trillion. Micron spiked 818% because US investors had only one door into this trade. July 10th is when the better door opens. In this video, I walk you through what actually powered the 818% run, the one number every Micron bull is not mentioning, and what you would need to believe for a 25 times earnings multiple to still make sense after July 10. Now, when I look at this market, one thing did not add up. SK Hynix has 60% of the AI memory market and Micron only has 20%. But the smallest player was the one every US investors was buying in. It is not normal, right? Here is the reason. On July 10, SK Hynix is listing on the Nasdaq as an ADR, which means any US investor will be able to buy it directly like any other stock on the exchange. It is raising between $29 billion and $33 billion in this single offering. That is the largest equity raise in history right after the SpaceX IPO. This is not a small company testing a foreign market. This is a dominant player in AI memory finally making itself visible to US investors for the first time. To understand why that matters, you need to know what the memory market actually is. Think of normal computer memory as a library with thousands of books. Every time your AI needs a piece of information, it walks in, finds the right book, and brings it back. That works fine for most software. But an AI model is not making one request at a time. It is making millions every second, and the library just cannot keep up at that volume. HBM is different. Think of it as the top 10 most useful books you check out and put in your backpack. You do not walk into a library. You open your bag and the book is already in your hand. That is why every Nvidia AI chip runs on HBM. 3 companies produce it: SK Hynix, Samsung, and Micron. Based on analyst research, SK Hynix is the largest with around 60% of the HBM market. Both SK Hynix and Samsung trade on the Korean stock exchange, so US investors had no simple way to buy either of them. When AI demand exploded, every dollar chasing the AI memory trade went to Micron. Not because it has the most market share, but because it was the only company with a US address. That's the reason why Micron stock went up so much. And July 10 is when that address stops being exclusive. But before we get to what that actually does to this trade, you need to see what Micron built over the last 2 years. Because the earnings are extraordinary. And there is one number hiding inside those earnings that I have not seen a single Micron bull video address. Micron's most recent quarterly revenue, $41.5 billion, up 346% from the same quarter 1 year ago. The quarter before that was $23.9 billion. Next quarter guidance, around $50 billion. I want you to compare this to Nvidia in May 2023, right before it spiked 10x like Micron. Nvidia reported $7.19 billion in revenue that quarter and guided the next quarter at $11 billion, which was 52% higher than what analysts expected. The stock surged 25% overnight. Then revenue kept climbing. $13.5 billion, then $18 billion, then higher every quarter. Micron is doing the same thing right now. The same shape, the same acceleration. But at that same earnings explosion stage in 2023, the market gave Nvidia around 200 times earnings. Micron today is at 25 times. The market is making a specific judgment there, and it is not an accident. Nvidia has CUDA, the software platform every AI lab, every research team, and every data center uses to program Nvidia chips. CUDA took 15 years to build. Switching away means rewriting everything. The lock is software. and it gets stronger with every researcher who builds on it. Micron's version of that lock is a contract. They signed 16 of them, 5-year terms take-or-pay structure, which means customers must pay committed volumes even if they do not actually buy. And $18 billion in cash deposits are already sitting in Micron's accounts. Total commitment, $22 billion, covering around 40% of revenue at floor prices. Here's the thing, a lawyer can renegotiate a contract. You cannot renegotiate access to 15 years of developer ecosystem. Now, here's what the AI premium on this stock is actually built on. But the next number I'm about to tell you, I reread 3 times to confirm it correctly. HBM, the AI memory chip, was around 3 to 5% of that $41.5 billion revenue. Can you believe that the entire Micron valuation story is sitting on a 3 to 5% revenue product? And if this breakdown is useful, hit like and subscribe so it reaches the next person thinking about this trade. Apart from that 3 to 5% HBM revenue, around 24% of the revenue is NAND, which is flash storage. The other 70% or so is conventional DRAM, the memory inside your MacBook, your phone, your regular server. And in that 70%, there is a company now offering the same product at 30% cheaper. Apple actually went to the White House to get access to it. Think of conventional DRAM the way you think of face masks in 2020 when COVID just started to break out. In 2020, face masks were scarce, prices were up, and every factory was running. But a few months later, every manufacturer on earth pivoted to produce them. Supply flooded the market and the price collapsed. That is the cycle. And conventional DRAM follows it precisely. When prices spike, every manufacturer accelerates. Supply catches up, prices fall. The company best positioned to pressure Micron in conventional DRAM right now is a Chinese manufacturer called CXMT. They produce conventional DRAM at approximately 30% cheaper than Micron. And Apple is currently lobbying the Trump White House to remove CXMT from the Pentagon's list of companies considered linked to the Chinese military. Here is how serious that lobbying is. Apple raised MacBook prices by up to $200 and iPad prices by up to $150 and publicly blamed memory costs. When that news broke, Apple's stock dropped 6.12% in one session, which is $265 billion in market cap gone in a single day. The world's most cash-rich company went to the White House to ask permission to buy from a company the Pentagon flagged as a military risk, because Micron's prices were that difficult to absorb. In 2023, Apple was squeezing Micron to a gross margin of negative 32.7%. Micron was losing money on every chip it sold. You say that out loud when you are the one with all the leverage now. But here's the thing about CXMT. They cannot make HBM. Their entire competitive threat is in conventional DRAM, the 70%. HBM is a different manufacturing process and only 3 companies have built it at scale. Micron's 10-year average price-to-earnings ratio is 16.78 times. Today it is at 25 times. At that historical average, on the earnings it is producing right now, fair value is around $743 per share. The stock is at $1,132. That gap does not require anything to go wrong with the business. That is just the multiple compressing back to Micron's own history. The contracts are the new variable. $22 billion committed, $18 billion already in cash. Customers pay even they do not buy. But here's a number Micron has never made public: the price floor. The actual minimum price under those contracts is not disclosed. If that floor is significantly below current prices, the protection is smaller than the headline suggests. No analyst has verified it. And cannot be cancelled is what Micron's chief business officer said in a public interview. That phrase does not appear in any SEC filing. The following says take or pay. Customers must pay committed volumes or forfeit deposits. Meaningful but not the same protection. So here are the two questions you need to answer before you buy Micron stock at the current price. First, does the market now see Micron as a cyclical stock, or has it genuinely evolved into a different category? That is the entire story behind PE going from 15 to 16 times historically to 25 times today. Second, when SK Hynix lists, does SK Hynix market cap surpass Micron? Does Micron's market cap come down to match SK Hynix, or does it settle somewhere in the middle? Because wherever it lands, that might be the true price the market puts on this trade. Let me know what you think about that. Last week, I made a video about another stock that trades at roughly half of what its assets are worth. The CEO just received the cash to start closing that gap. It is the time-sensitive trade and the window is closing soon. Click here to watch it now.